If you've been invested in markets for the last 10, 15, 20 years, you got rich. The next part is how do you stay rich?
That's what it means to be a political utility. It means that the state recognizes that the number must continue to go up for the social fabric to remain intact.
Everything that has worked for 40 years is probably not going to work for however long this next part of the cycle works.
I don't think it's possible to have an edge in fundamentals. My belief. Where I think it's possible to have an edge is understanding where you are on the life cycle of these narratives.
The business is the stock price these days. And once you do that, once you change this business to be about the stock price, you change every incentive that has been developed over hundreds of years of capitalism.
So, Matt, my favorite people to do these clip shows with are people who challenge what I believe about investing. And we've got two people today whose views challenge a lot about what I believe investing. So I'm excited to do it. We've got tons of clips. We've got like 30 minutes of clips, more than we usually have. And we're going to talk about Ben Hunt and Grant Williams.
I like to imagine like Ben, young dad, all the little girls running around him, and they look at him and they're like, Dad, why are you telling me this now? Like, if they could just weaponize some of that stuff going on in that big, beautiful brain it is against him, I got to imagine that happened in the household. But me too. Ben and Grant, both fantastic thinkers. They push my brain in all sorts of new and exciting directions. And just, I love revisiting these clips because even though these are older interviews, there's so many ways we can think about this stuff right now today.
Yeah, and there's such broad concepts, and these guys it applies to so many different things. I mean, I was thinking about all the times we've had Ben on. We had him to talk about like the strategy behind the Russia-Ukraine thing. We've had him to talk about narrative, as an investing factor. You had him on to talk about investing in the post-Trump world. Like, it's just the depth of this is really cool.
Yeah, and it's all based on stories, which is the overarching theme through all these are what are the stories being told and what are the stories that we, all of us as people in markets, people in society, what are the stories that we're actually taking in, retelling to each other, and how does it shape the existence, the reality around us, which is why these are evergreen topics. It's always really good to go back and revisit some of these points.
So let's get into this. If people want to hear from us, they want to hear from them. So this first clip, I think you were asking both of them about this general framework of investing in a post-Trump world, and they both had ideas. So here's Grant talking about this idea of we got rich, now we have to stay rich.
Yeah, I think there are, but I think they're very, very difficult for people to do intellectually, because if we go back to late 21, when interest rates started to go up, at that point, if you could take a step back far enough and just think about that in isolation, not what it meant for your portfolio the next day, but this idea that we are now in a rising rate environment where the pressure is on rates to go higher. If you could step back and look at that as a construct, you immediately were faced with the realization that everything that has worked for 40 years is probably not going to work for however long this next part of the cycle works. And that's a really difficult thing for people to face, because it means that, all the things that have happened to them that have been great and they've made a lot of money and things have worked. And my friend Rick Rule always has this great line, don't confuse brains with a bull market. And he's absolutely right. There's a fundamental shift that has to happen here if you're going to survive for the long term. And again, this comes back down to this idea of you're an investor or a speculator. If you're a speculator, as Ben said earlier, and Chuck Prince said, the band's playing, you got to keep dancing, but you want to be doing the mashed potato closer and closer to the door. But there's a whole bunch of smart people doing the same thing. And, if you don't make it out the door, you're going to get punched by a stray arm going at you. If you're an investor and you find a way to give yourself the time and the space to be thoughtful and not get caught up in the noise, whether it's political noise, market noise, central bank press conferences, all this stuff that ultimately is filtered and fed into the number, i.e. what did they say, what did they do, and what does it mean for the number? if you can sit back and say, okay, what are my objectives for the next 5 years, 10 years? Because it may take us that kind of time to get through this and out to the world that Ben and I struggle to comprehend, but we know it's there because mankind's been through this and to that before. And so try to understand that you're going from a world where 0-day options are your instrument of choice to trying to think of something that you might want to own for 10 years is an extraordinarily difficult mental exercise for people to do, but I think a very, very valuable one. And so, you know, in 10 years' time, are we going to need 0-day options? I doubt it very much. I think from what I've seen in the last 40 years of my career, that will at some point do the kind of damage that makes people swear off ever touching 0-day options again. Will we need copper and iron ore? We will. We will need these things. It becomes a question of need. Will we need to own companies are all about the promise they offer for the future? Well, if you understand that the future is going to be very different to the present, then companies that are really based on a promise of an extrapolated future are probably not going to be much good to you. But businesses that have been around for a long time, I'm just pulling out the top of my head here, the Nestle's of the world, companies that produce things that people consume. Full disclosure, I have no position in Nestle. Those are the things that you're going to want to focus on, but you're not going to have the dopamine hit, again, that Ben writes so well about checking your IRA every month and it's up another couple of %. You're going to have to buy things that you have confidence in, that they are well-run businesses, and no matter what happens, the business is going to still be there through the other side of this, and the business is something which we will need on the other side of this, and invest in a completely different way that prioritizes resilience and stability and longevity as opposed to profits and growth and all the things that have attracted all these speculators to it in the first place. And it's a very difficult shift for people to make mentally because the way things have been so profitable and so successful for everybody. But as I've said before, if you've been invested in markets for the last 10, 15, 20 years, you got rich. The next part is how do you stay rich, or how do you at least give back as little as possible? Because we're all going to give some back. How do you hang on to as much of it as you can? That's very much the way I look at it anyway.
So yeah, this idea of the 40, whatever's worked over 40 years is not going to work in the future is something I think about a lot. I mean, you've got people on both sides of that. You've got the people, the Rick Ferries of the world who are telling you, you can do the same thing. It may not be consistently as successful, but you can do it. But this idea of something change in the next, whatever many decades is going to be different than the last 40 years is an interesting thing I think about a lot.
You and me both, especially when we put our advisory hats on, right? Like this is a big part of it. To get rich, you have to do something different. To stay rich, you have to do something kind of the same. You have to figure out the way to tread water and not fall behind. But to get rich, you have to figure out, how am I going to outpace not just my peers, but the markets, whatever else. One thing I love about both Grant and Ben in this case is they're not out there trading 0 DTE options or doing something completely wacky at the margin to try to make some big life altering bet per se. Maybe they are. I shouldn't speak too soon. You never know. But the idea here is what do you have to do and how do you understand that in the context of history? Because also what got us here might not be what gets us through the next leg. How do you think about that? Because it's this out of sample thing too that comes into this.
Yeah, exactly. And delineating speculation from investing, because a lot of people who have got rich have done it. And again, this is not when we had Michael Mauboussin on talking about speculation, he's I have nothing against speculation. Just know what you're doing. And that's the same thing. A lot of people who have gotten rich got rich through something we might call speculation. Now, it doesn't mean they're not rich. They're still rich. But it does mean that what you learn for the future about that and what other people who watched you do it learn for the future is important, because Grant talked about this idea of what will we need in 20 years? Thinking about it from that perspective, the businesses that'll be around in 20 years. He referenced copper in there. The way a lot of people have gotten rich in the most recent decades does not tie to that at all. So it's just interesting thinking about this idea of speculation against this idea of what will we need in 20 years.
The other grounding principle inside this is building or doing tangible things. And there's a lot in these clips about the intangible or the less tangible realities of building in tech, scaling in tech, and all the stuff of growth investing over the last 20 or 30 years. But this framework of what can you do that's durable, repeatable, and actually creates productive use and value writ large in society, or writ small. Is that even a word or an expression?
Well, you just made it up if it wasn't.
Hey, writ small. You're even on excess returns first. But this idea of like build tangible stuff that has an impact that's demonstrable, and you don't have to scale it to the moon. And that's our entire professional experience in markets, right? You and me both, I think. Like we've only been hearing about people who want to build stuff to the moon.
Yeah, absolutely. I mean, I wish I had built more of the moon myself.
Yeah.
I'm still going for the moon.
You're not going for Mars.
Probably not going to make it.
Go all the way past the moon. Just keep going.
I might as well. Yeah, whatever's beyond that.
Mars. There you go.
So you asked the same question to Ben, and here's Ben talking about the market as a political utility.
Well, first I'll start by just seconding everything that Grant said, so that makes it kind of easier. I'm really glad Grant went first. I think what I would add to that, and it is an addition, is recognizing that capital markets have been transformed into a political utility since the great financial crisis, right? And what that means is that so long as we have political, I'll call it stability, the number will go up. That's what it means to be a political utility. It means that the state recognizes that the number must continue to go up for the social fabric to remain intact. So neither Grant nor I are saying, oh, well, get out of that. We're not saying to get out of it. We're saying to recognize what it is. And that so that you know the game you're playing. And what I think Grant is also saying, and I want to suggest also, is that a political utility is not where you want to put either your heart, and it's certainly not where you want to put, honestly, your wealth. It's a tool. It's a tool. It's not the foundation.
Amen.
The foundation is, in my advice to everyone, and it's advice I have a hard time taking myself, right? When you say, oh, people should be shouldn't be online so much. My God, I'm hooked to this thing. I mean, it's terrible. It's like any addiction, and it's something that I'm really trying to break, but I'm not talking down to anybody. I wrestle with this very much personally. But what I'll say is that, you know what? I don't have a personal account. I'm not involved, doing the market. I have a retirement account, which is in the political utility. But my, not just wealth, what little there is, but my attention, my energy, my heart is in 3 investments. I am levered long to my children's education, my home, my principal residence, and my business. Mm-hmm. That's it. That's it. I'm not spending any more time and heart and attention on trading this market. So in this case, I really do practice what I preach, and my preach is develop your own expertise and invest in that, right? Invest in that expertise and those people who you meet, who you trust. Invest in that. Invest your money, and most of all, invest your heart. So
That's
Yeah.
that's my addition to what Grant's saying.
So this idea of number go up, and we should say that this was recorded last fall. So right after Trump won the election, this was recorded. So it doesn't take into account everything that's happened since then, but I think all of it's just as applicable. This idea of number go up and this idea of a political utility, and the political utility took me a little while to understand. I mean, if you think about like your electric utility, like the government has an incentive to make sure your electricity is not down. And there's the same thing here, which is basically the government, whether that be the Fed, whether that be, fiscal authorities, have an incentive to make sure your stock portfolio is not down, at least to a massive extent. So I think that's the idea of a political utility.
Yeah, political, politicians, utilities, tool. The politician's tool is the public markets. And when the public markets are up, generally it's a sign that sentiment is better. It's a better way to get reelected and all this stuff if you want to be a politician. Ben's point that he takes further, and I'm curious how this one hits you, when he talks about I think it's my family, my house, my business as the foundation, and understand the other stuff is just tools. What's the read through on that? Is that too philosophical, squishy for you, or?
No, not at all. And what's interesting behind that is he was the one, we have this show Us Your Portfolio we do, and he's the one person who's ever come on that show and been like, I don't have a public portfolio. So we couldn't ask him about his stock and his bond allocation and all this other stuff because he doesn't even have it. He said he invests in his home, he invests in his business, he invests in his children's education. And I think that's really cool. I mean, you can comment on it from a financial planning standpoint. I mean, a financial planner may say you don't do that, but I think it's really great. I mean, he's investing in the things closest to him. He knows the most about his business. Obviously, he wants his children to be successful, to be educated. So I think it's a very cool idea.
If political utility is the tools of politicians, then a personal utility is things like your family, your house, your business, the stuff that you have direct control over. And those are still tools and instruments that you use in a way that's good for that greater whole. I think you can relate this back out to things like Social Security too. I know not to get into the Social Security debate with people, but I'm sure we'll get some fun comments. It's like Social Security is a form of a political utility. It's a social and socialism start with the same word for a reason. But it's not your money once it goes in. It's now in this socialist structure that's going to pay out and distribute these payments. It is a utility in the sense that it's a tool that helps benefit this whole wide net of people, but it's not necessarily for your direct benefit. You don't have direct control over this in a one-to-one way. It's a one-to-many relationship. And when we think about that, you start to go, what are the other political utilities in my life, whether it's public markets or Social Security or whatever else, that don't make this the foundation of your plan? Make the foundation of your plan the things that you control, your own personal utility, and then understand the ways you can use these other public utilities to help support that broader cause. But you don't want to leave them as entirely foundational if you have the chance to do so.
Did you see Rusty's tweet today on this?
Oh God, no. Did we?
Yeah, so actually
get it up on the screen. We can share
Ben's partner, Rusty Glynn, had a tweet about this today because one of these congressmen had tweeted, Social Security is your own effing money. Rusty retweeted it and said, no, it's not. And so to your point, it's basically exactly what you were just saying.
There's a building not far from me. And on the building, and I'll see if I can get this to you. I literally took a picture of this later because this has been driving me crazy. And I'll see if I can send it to you. On the wall, it says socialism sucks. But then there's a skeleton in a wheelchair that says Medicare for all. On one hand, I can't tell if they're just being funny. Because if they're being funny and they're like, it's a dead person in a wheelchair and socialism sucks and Medicare is socialism. And so it's a dead person in the wheelchair, it's a skeleton. I'm like, oh, okay, it's kind of funny. I get at least the funny and the peculiar, ironic point that they're making. But if the point is actually socialism sucks and they just have like a skeleton in a wheelchair and, Medicare for all next to each other, I don't think they understand the juxtaposition. Maybe that politician lives near me. Maybe that's who did it. The same guy Rusty was tweeting.
As you know, Matt, any of this stuff with depth doesn't work for me. I mean, we got to get Bogomil back out here to try to work through this with you.
Bogomil, you're my lifeline for existential.
Yeah, we'll pop on the screen and be like, I'm phoning Bogomil. But the one other point I would make on this before we get to the next clip is this idea of, I could use this idea of the market as a political utility on like some bearish, YouTube cover, but it's not bearish really. People, when they hear it, they sound like they think it is, but it's not really, that's not what it is. It's not negative for market. It's just, you have to understand markets for what they are. And so I think that's an important, connection to make here is that's not what Ben is saying. He's not saying you shouldn't invest in markets or markets are about to tank. He's just explaining something going behind the scenes that's changed about markets from the past.
Right. He's telling you, think about markets as a tool now being not operated, it's not a shadow scheme thing, but it's like there is a political utility. There's a politician's reality to how this tool is implemented in society. And you should be aware that those people who now have a vested interest in telling this story have a different interest in telling the story than they did 10 or 20 or 30 or 40 years ago. And that's what Ben's great at. That's why we have him on these shows.
So this next clip gets into a little bit into Ben's idea of narrative, but I love this idea of the day of theater. So here's Ben talking about that.
IBM, kind of old school value company. Gina Romity, she couldn't tell a story to save her life. Not to save her life. It is why, my view again, I think she was a very poor CEO for this era, for this modern age. And there are a lot of them out there. We could name some others, right? But she's just, for me, the poster child for this. Because, I mean, this was an investment strategy you had, right? Where you could be long IBM 350 days out of the year, but when earnings, 4 earnings announcements a year, man, I want to be short IBM for a day. I just want to be short IBM for a day. Because, I mean, we did a lot of work on the data on this. I mean, IBM does fine, except for those, we call them the days of theater, right? Where, you get out there and you have to tell a story and the stock reacts typically with some ball, right? On the day after earnings. Gina Romity couldn't tell a story to save her life about all those acquisitions they were doing. Watson, right? They were doing freaking AI, is marketing AI, right? Watson was crazy, but they couldn't tell that story to save their lives. Contrast that with Mark Benioff, the CEO of Salesforce, a company that, well, maybe they'll have a little bit this year, but for the last 25 years, they don't have any net income. They don't have any GAAP earnings. None. It doesn't exist. Right? But man, could he tell a story about free cash flow? Man, could he tell a story about, at some point, yeah, this is going to be profits. It never is. They have a business model that does not allow them to be profitable. Right? It allows them to sell lots of software with a recurring revenue base, and reward their salespeople for all that they move out the door. But it's a business model that doesn't allow that to trickle down. It would be a trickle to shareholders, but it didn't matter for the stock. Right? It didn't matter for the stock. Salesforce is just the exact opposite of IBM. So over this 10-year period that we were tracking, you could, and I was often in my former hedge fund, you could be short Salesforce every day of the year, except the days of theater, the days where Mark Benioff would get up, do his song and dance about pro forma net revenue growth, whatever the hell that is. And I say that intentionally because it's whatever the hell Mark wants it to be. Pro forma net revenue growth, right? It's a totally made up thing. But if the 4 or 5 axes on the stock, the 4 or 5 sell side analysts who are the names on the stock, if they buy into the story also, and they all do, then I'd be short the stock and I'd be listening to the earnings report and I'd think, oh my God, what a disaster of a quarter. I'm finally going to get paid on this short. No one could listen to this song and dance and think it was anything else but a disaster. And then I'd wake up and I'd see coming over at 7 or 7:30, what's his name at JP Morgan, who was would put out his piece saying, woo, look at that pro forma net revenue growth. And I go, oh shit, I'm gonna get my teeth kicked in again. So I learned I could be short Salesforce every day of the year. And typically I was, and I did well, but you get out of the way for a showman when he's putting on a show.
This is something he explained that I've been thinking for a really long time, which is the job of a CEO these days is very different than it used to be. It is less tied to the financial statements. I mean, that stuff obviously matters, but it's less tied to that than it has been historically. These CEOs that can get up there and can tell a phenomenal story, can keep their stock prices up, not for one day. He's talking about the earnings day and the performance of Mark Benioff against the CEO of IBM. But think about Elon Musk. For a really, really long period of time, these businesses can trade at premium multiples for a long time because you're really good at telling a story. So it almost has become an essential job of a CEO to be able to do this stuff. Don't you think?
Yeah, absolutely. This whole idea that people buy a story about a business, but they don't, you don't buy the business in isolation without the story. You buy the story about the business, and it works in this layer. And this idea that there are points in time, there are these points in theater, quarterly earnings in this case, and what were the 2 examples? Was it Ginny Rometty at IBM and Mark Benioff, I think, are the 2 that get mentioned?
That's correct.
All right. So you have points, like you have the quarterly earnings report where these people are going to go out on stage and we can kind of like judge the way they are telling the story about what they're trying to accomplish by the market reaction on those things. This idea that every single one of these stock prices is tied to the story and the ability of the person at the forefront of the company's ability to communicate that story to their shareholders, where they say, thumbs up, we like this story, or thumbs down, we don't, it seems so obvious, but to have somebody say it so clearly is such a powerful wow. Same, and he's wrecked me on a long time for this one. Like ever since he talked about shorting Salesforce, be like, you can short Salesforce basically almost every single day of the year, except for the days of theater around the earnings reports. That's a profound way to look at this. How do you make sense of that?
Yeah, I mean, it just means it means exactly what we've been saying, which is Mark Benioff is obviously very, very good at not only performing on that day, but also like Salesforce has their own metrics they made up, and some of these other companies do too. Like they report things in such a way that they can tell the story. So the metrics, the things I'm worried about as a quant, get tied to the story. And I don't think this is, I mean, I'm a value guy, so I tend to be like the guy shaking my fist at this. This is crazy and markets are out of control. But I mean, you've got to play the fear of the game that's in front of you, right? I mean, this is the job of a CEO now. I can't look negatively upon that. Like it's your job, if you're a CEO, to keep your stock price up, or at least in part, that's your job in the world we live in. So I think I probably need to do less shaking my fist at it and more realizing it's just the reality of where we live.
Yeah, I think, I don't want to say it's a jaded or cynical. You can do this without being jaded or cynical too. I think that's important to say. You can accept that the reality is CEOs or anybody in any business is going to be able to frame a problem in a light that is beneficial to their business. And if you start to understand how are they framing this, and then what parts of this am I going to sniff out the BS on, and which parts of it are like, wow, that's a really powerful framing. A lot of people are going to buy into this, and this is where it could carry them. Better just to be able to think that way than to just be mad at it. I think that's my
Yeah, right. Because I think in 99.9% of cases, this is not like somebody committing fraud and making something up. This is somebody framing the story in the proper way, to benefit their stock price. I mean, to benefit their shareholders. I mean, I think that's what a lot of this is.
Yeah, and you have to be able to, again, back to the BS sniffing test of, I'm thinking of like the WeWork example, whatever their crazy EBITDA adjustment.
Community adjusted EBITDA. I remember that.
Adjusted EBITDA, yeah. Like, where it's like,
I don't even know what that was, to be honest.
You should be able to look at that and be like, great, let's sidestep this if we're not shorting it. Let's just sidestep. We are now into the abstraction land of insanity. You want to be able to do that. But at the same time, you also want to be able to see like, wow, this person just reasserted what their total addressable market is. And it might be a lofty or a crazy goal, but in that reassertion, did they just provide themselves the capital base to maybe make a run at this crazy new TAM? And we've seen that in a lot of the tech companies in the last several years. If you have this language, you at least have the language of understanding what's going on and then saying why I may want to participate in this, and also what's the stuff I want to steer around. Both are equally important here.
So this next question is something I asked Ben because I was thinking about it at the time. So if you remember pre-2022 or even 2021, when the tech companies started to fall apart, these tech companies were like, we're going to spend everything as possible. We're going to grow to the sky. Who cares about earnings? Like all that stuff. And then it's like a switch flipped in 2022. And it's like, we love cash flow. We're all about the cash flow. And so I asked Ben to explain that to me.
Well, it's a really tough question because it's hard for non-mega cap tech stocks to make that switch. And it's even more difficult for non-public, right? Still, early, mid, late, growth stage stocks, non-public tech stocks to make that switch. The reason being is that value investors don't invest in venture. Value investors don't invest in high-flying tech stocks. It's not their language. They don't speak that language. Right? There's a language to growth. And I mean this in a true language, right? So growth investors speak to each other with a certain language. Value investors speak to each other with a certain language. The two rarely mix. There's an inflection point in tech stocks that they reach a size where they've got all this freaking cash and they can't grow the way they could before. So it's been very difficult for these mega cap tech stocks to continue being attractive to a growth investor, to keep speaking their language. They've all found master storytellers to tell that story in a language that growth investors appreciate and they want, is a story they get, so it's kept on working. With rising interest rates, nobody wanted to hear that story anymore, and that story didn't work. It still didn't work. It still doesn't work non-mega cap tech stocks. But mega cap tech stocks are, at their heart of hearts, they already are value stocks. Right. They really are. They can change these levers like Meta does or Microsoft does. They still want to tell a story that appeals to the growth investors, but they actually look and feel more like a company that they can tell a value story also. And that's what these mega cap stocks were able to do. And you see the results. You see the freaking results. It's funny, you know, once you start seeing the world through this lens of language, you know, are you telling a story that appeals, that are you using growth words? Are you using value words? What audience are you using growth words to? What audience are you using value words to? Once you start looking at that way, you think, I mean, it's pretty eye-opening. So your point, you start seeing it everywhere.
Yeah, you know, for me, like, but when I listen to like a podcast with a VC, like, I don't know what the hell they're talking about half the time. They're using all these abbreviations, and like, you know, I'm the value guy with the value words, and I don't even know what they're talking about. What's the
preference stack here? You know,
Yeah.
and it's a different language. And once you start thinking about that as in a truly linguistic sense, like the difference, but you know, how did the, you know, Indo-Aryan language family evolve into, you know, Romance languages and Latin languages? You know, there's Finno-Ugric over, you know, some of those interesting and, to my world, useful analysis on understanding how we talk to each other in markets actually comes from this kind of very old school research in linguistics. It once you start thinking about it this way, it's pretty mind blowing how it again, you see it everywhere.
Yeah, this idea of the language of growth and the language of value. And I don't speak, as you know, I'm more of a value guy, so I don't speak the language of growth very well. Like, I don't know these terms. Like, Ben, I forget what the one he referenced in there, but there was a term that I'm like, I don't even know what that, the preference stack or something like that, that I don't even know what that is.
Yeah.
But it is interesting how these companies switched from, they were speaking the language of growth, and then they started speaking the language of value in the post-2022 period.
This idea, and I'm going to say it again, you buy a story with the business, you never buy a business without a story. And inside of that story starts to determine who is the audience for that story and why does this jive, work, whatever with them. And another great way I love to think about this is, like, I think about Warren Buffett. I think about Berkshire Hathaway. Warren Buffett for years was able to say, tech is not in my circle of competence. And all the value investors that he told that story to were like, yeah, obviously. Like, what does that guy know about an iPhone or whatever, right? Like, it makes total sense why Mr. Werther's Original and Coca-Cola and Dairy Queen isn't going to know about the hot new tech stock, why he's going to say outside of my circle of confidence, and everybody gives him a pass. Now, where that flips is him starting to go like, oh, I can understand this on some of these terms. And he was one of the first people that we saw bring the language of value investing into, I mean, let's face it, a company that was still trying to say they were a growth company. But Warren Buffett was one of the first people to go, let's re-understand Apple in this new framework as a consumer staple company with maybe a luxury good and this types of cash flows and this types of cash and all the ways that I can use my language to now sell it to my people. That is the amazing part about how a story is attached to a business, and then an investor can go in and repackage that story for their own purpose. It's not just style boxes. That is something that Morningstar told you, right?
I've got to flip this and figure out how to use the language of growth for my value companies, because maybe I could get a little bit of, you know, the market to care a little bit more about it if I could talk about the 2% screaming growth they've got going or something like that.
Yeah, I mean, you know, there is a good word of when you can take a value company and apply growth words to it. Do you know what that wonderful word is?
I do not know.
Fraud. It's usually fraud.
So maybe I should stay away from that though.
Maybe stay away from that one.
So this next one is back to Grant, and this is the idea, and it plays on some of the stuff we've been talking about already, but this idea of the business versus the stock price and the disconnection between them. So here's Grant talking about that.
My Twitter feed is inundated these last few days with people who took, $10,000 and turned it into $1 million with 0-day options on Tesla this last week. How great's that? So I kind of mourn the change in capital markets as a means to allocate capital over the long term to productive use that will provide a steady long-term return on capital and will help grow a business. That's what this was all about when I got into it 40 years ago. And I don't recognize it anymore. I don't have any of the conversations today that I had 20 years ago, 30 years ago, 40. None. All people want to know about is the stock price. And that comes down also to CEOs of companies. The business is the stock price these days. And once you do that, once you change this business to be about the stock price, you change every incentive that has been developed over hundreds of years of capitalism about how to build a sustainable business, how to reinvest profits and grow a business. And so this has, Ben writes so brilliantly about this so often, this has become a meme world. It's become a cartoon world. And there are millions of people who call themselves investors who are nothing of the sort. They're purely speculators. And I've written about this and spoken about this last year because it's become so apparent and so important to me. If you think you're an investor, but you're a speculator, or vice versa, ultimately you're setting yourself up for failure because what you're trying to do and the methods which you're using to try and achieve that aim are incongruous. So it's, I find it very difficult, to be honest, right now to do anything but try to remove myself as much as possible from the daily noise. I think that's the only way. I watched War Games recently again. It just happened to be on at some stupid hour in the morning when I was jet lagged. And you get to the end and, we all know the end. The only way to win is not to play. And I really do feel that way.
Boy, Grant, I just wrote down your point about how you don't have any of the same conversations today that you did 20 or 30 years ago. I feel that too. But I think that's, I care so much about language and the words we speak and read and hear. And that's exactly right. The stories we used to tell each other about the meaning of markets, those stories are gone. Those stories are gone. There are new stories. There always are. But the old stories, they're just gone. They're just gone. And I feel the same way that you do, Grant, about that my reaction is to withdraw. That's difficult for you and me because we're also out there, right? We are public facing. And so there's a real tension here because inwardly I withdraw. I think I see very clearly where this is all going. To Matt's point earlier, that doesn't mean that I'm saying, oh my God, sell everything and go to gold. On the contrary, my advice is, like Chuck Prince said before the GFC, when the music's playing, you got to get up and dance. And brothers, the music is playing. The music is playing. But like you, Grant, my faith, it is like the stories I would tell us about what are the purpose of markets to get capital into the hands of real world companies doing real world things. That story, it doesn't exist anymore.
Yeah. So, and this gets back to what we've been talking about, which is a lot of businesses are managed to the stock price now. They're more concerned with what is the stock price than what is the business. And I think a lot of investors these days, going back to the idea of speculation, a lot of investors know very little about the businesses they're actually investing in. They're investing based on what's going on with the stock price. So I think it's a great point by Grant.
It's also an amazing point to basically say, if I don't understand what the company really does, if I don't really understand how to value the company, why would I bother with the stock when I could just come straight to zero DTE options? Like, it kind of makes a lot of sense to me in that sense. And I want to shout this out. Long-term money with productive use, outstanding sense, big capital allocation nerd over here, so I can get behind that. I also want to just shout out the War Games quote. Were you a big War Games fan? Is that a big movie for you?
No, I don't remember much about it.
War Games is the movie where I learned what DEF CON meant.
Oh, okay, yeah.
Do you know, like, do you actually?
Yeah, is there
know
how
what
many? Is there like
DEF
5 DEF CONs? Is that the?
CON- There is, but like, do you know what it actually, I guess, stands for? This is some military person can yell at me in
No,
the comments.
I
Please,
don't.
please add nuance to this or add sources. If you're still listening and you can tell me about DEF CON, now is your chance. I would love this because I learned this from War Games, 35 years ago, and did not research this deeply before making this comment publicly. So like, DEF CON is defense condition. And like DEF CON 5 is peace and DEF CON 1 is like all out war. And War Games is what taught me, like, going from like DEF CON 5 to DEF CON 4 was like, uh-oh, you've just taken peace and you've turned it in, your defense condition has now shifted and all the pieces on the game. I also want to shout out, if I was going to use a War Games quote for this, I would definitely use, there's this great scene with the teacher and they're in the classroom and the teacher says, calls out the kid, could you tell us who first suggested the idea of reproduction without sex? Do you remember the scene?
I don't know.
This is me in high school all over again. He's
You're,
like,
you're the king of the pop culture stuff. I mean, you remember all this stuff.
he's like, your wife? And he gets thrown out of the class. Amazing. But anyway, long-term money with productive use. So this idea of like framing it of, are we actually not just thinking about the instruments where we're speculating? Somebody still has to take up the job of thinking about what is the future that we're actually investing in and building. And that is, like, Grant is right to raise this question with the aplomb that he raises it.
Yeah, and hopefully we're going to get back to a world at some point where that's the case. I mean, unfortunately, if you look at some of the work on this, like, we may have to go through a little bit of an ugly period to get there. But I mean, I definitely am a big fan of, valuing businesses and thinking about what's behind the stock price and all that stuff. So, hopefully we'll eventually get back to a day where maybe that matters a little bit more.
Maybe it matters a little bit more. And if nothing else, do you feel like this goes back to like the tangible companies and the stuff, definitely in the value space? I mean, it feels like there's already an added incentive in these times that we're living through to like do some of that. I don't know if the capital is going to be like rewarded in flowing to these spaces or not, but some of those incentives feel like they're more there than ever right now.
Yeah, I think so. Some of the things that were not that have done a lot more, have struggled a lot more recently. So I think people are caring more about that kind of stuff. And I think everything is in cycles. Yeah, I don't think, I mean, people are always going to care about narrative and people are always going to care about the stock price, but it's like a pendulum that swings back and forth. I mean, to what degree they care about these things can change over time. So we might be moving a little bit more towards the real, the tangible, the fundamentals, like that kind of stuff.
Well, here's to that, and here's to your value investing strategies.
Exactly.
What's the
Someday,
next
Matt.
one we got?
Someday.
Principle.
So the next one we've got, and this is probably the biggest thing I've learned from Ben, is this idea of all his work he's done on narrative, because we hear these stories out there, but he's doing actual quantitative work behind the scenes with the unstructured data that is all this stuff. So I think this Law and Order is a great example. So here's Ben talking about the life cycle of a narrative.
I mean, again, I'll point people to, well, this time not movies, but a TV show, right? I watch a lot of TV. People say they don't have time for TV. I say you make time for TV. So Law and Order, 23 seasons, I think now. There are, of the core series, there are lots of spin-offs, but the core Law and Order series, there are, right, I think about 600 episodes have been filmed. I haven't seen all of them. I've seen a lot of them. But what I can tell you for Law and Order, for those 600 episodes, there are only 12 scripts. Not only are there 12 scripts, but each script is a 3-act play. In fact, every script of every scripted TV show, every movie that the three of us here have ever seen, ever, is a 3-act play. There's a structure to it where you have what's called rising action, through scenes through acts 1 and 2. The rising action peaks 1/3 of the way through act 3, and then you have what's called declining action. It could still be a lot happening, but it's It's not building up to the epic climax, right? The last parts of last half to 2/3 of Act 3 are declining action. You have what's called a MacGuffin, anywhere between 1/3 to 2/3 of the way through Act 1. This is the object of desire, the thing around which the plot develops. In Law and Order, you can always tell that there is a presumably tangential character, right? So the crime's committed, it's investigated. A character is introduced halfway to 2/3 of the way through Act 1. It's a family member, it's a neighbor, it's an associate, someone who is apparently not directly involved with the crime. At the beginning of Act 3, that tangential character is reintroduced as the pivotal character. You can often tell, that there will be a recognizable character actor who plays the part of this tangential character introduced 2/3 of the way through Act 1 to reappear at the beginning of Act 3 to be the major character. Every episode has this, all 600 episodes. There are 12 scripts, 12 kind of basic plot devices that are followed within a 3-act play structure: rising action, climax, declining action, and this character is always introduced at exactly the same point of time to be reintroduced as a pivotal character later in the play. The point with going all through all this is that these structures have been developed down to a science, a literal science, in Hollywood. The same structures exist for the stories we tell ourselves about, pick a sector, the technology sector. Pick a stock, Microsoft. Right? Pick an investment style, value investing. Right? There is a beginning, a middle, and an end. There's a 3-act play structure to every story we tell ourselves. There are markers at each of these points. It is possible to identify the change in language that marks these different points. That's what we mean by tracking narrative, understanding the life cycle of a narrative. It's a little different for the movies, right? So in the movies, you've got one script, you've got one movie that's playing for you. Here in investing, we've got 25, 30 different movies playing simultaneously, right? It's not like there's only one narrative happening. There can be something that dominates our attention, like inflation today. That matters. We are looking at, as investors, typically, a couple of dozen movies simultaneously. Each of them has its own script. You're at a different point in the life cycle of each of them. And what we can all do to become better investors is just to recognize that this is playing out. Just to recognize it. To maintain that sort of critical distance and not to accept any of these movies or these scripts that is playing for us simultaneously as the God's honest truth. That's what we're all about in our research at its core, is showing investors how this process works. You can go down this rabbit hole as far as you like, but at a minimum, our goal is to have people see the world differently, kind of see beyond the news, and to understand that there's a story arc and there's a motivation behind the patterning of all the information we're presented as investors.
Is there like a point in the life cycle of a narrative where it's most investable? Like I would think when Goldman Sachs is telling all their clients and it's on the front page of the Wall Street Journal, it's probably not that time. But is there a certain period where it becomes...
Oh, it's investable, but you want to go short.
Yeah, okay.
No, I'm quite serious. No, it's so... I was a short seller in a prior, with my long short hedge fund. That was my book. I was a good short seller because I'm wired to be suspicious and to see the flaw in all things, trying to get away from that. But don't call it shorting, call it being underweight, right? So yes, the basic idea of all of what we like to call is narrative ARB. That's the strategy we're talking about, not stat ARB, which is using structured data. Narrative ARB, looking at the life cycle of where you are in a narrative and trading on that basis. This is not long-term investing. It's really not, right? But it's also not fast twitch trading either, because the life cycle of a narrative is typically, it'd be a very quick narrative that only runs for a couple of weeks. Typically what you see in a narrative, say around a sector, a financial sector, and we can talk about some of these narratives specifically, but they'll run on for it'll take a couple of months to build, a month to plateau, and then a couple of months to decline. But I promise you, there is that pattern. They build, they grow, they live, and they die. Why? Because the business of Wall Street is the same business as Hollywood. They are storytellers, because it is through stories that we pay attention to something, that we buy something, that we sell something, that we transact. The business of Wall Street is flow. The business of Wall Street is to get you to transact. And how do you do that? Through storytelling. So there's this ebb and flow of new stories. What do we want you to buy now? It's a new story. So yes, you track. Like I say, you can go down this path as deeply as you want. We go way down this path. We don't look. I have views about fundamentals in the world. I think they're smart, but who the hell cares, right? I mean, we're all smart guys, and it doesn't do you a lot of good, my opinion. So I don't even try to have an edge on fundamentals. I don't think it's possible to have an edge on fundamentals. My belief. Where I think it's possible to have an edge is understanding where you are on the life cycle of these narratives, because so few people try to look at that. We can all do it to one degree or another. And yes, Jack, to your question, you want to be overweight something in the early stages of the narrative when the drum beating is just starting up. You want to ride that wave up because price follows narrative. Say that again. Price follows narrative. Price can create narrative. Don't get me wrong, it absolutely can. It can reinforce narrative, and you can track it and you can measure it. But what you want to start doing, you want to be overweight something as the narrative is building. And once, to your point, once you open up your morning Bloomberg email and it's saying, oh, everyone is excited about what's happening in the financial sector or consumer discretionary, that's the time you want to fade.
Yeah, I love the 3-act play. And like, once you hear that, you see everything that way. Like, first of all, like, I kind of knew that the guy that comes out of nowhere in Law and Order, or the woman that comes out of nowhere in Law and Order, usually ends up being the killer at the end or whatever. But now it's basically ruined all the Law and Order episodes for me, because now when I watch it, I pretty much know, at the end of the first act, I know what's going to happen.
It doesn't ruin the episode though. Like, knowing the structure doesn't ruin it. In some cases, it enhances it. I don't know. Did you watch a lot of, what was your Law and Order of choice? I was an SVU guy. I've seen way too many SVU episodes.
Yeah, I'm old enough that I remember when there was just the one. And I was watching that back in the day with the original guys.
Well, you can't beat it. How
many are there? There's probably like 20 now or something. I mean, there's an outrageous number of Law and Orders, right?
There's an outrageous number. And if nothing else, the gift is that we have, like, I don't know if you've ever heard John Mulaney's Ice-T impression from years ago, but like, the riffing on this show is just incredible. And the comedic stuff that it's produced in its wake. Make sure you look that up if you haven't seen it. You understand the 3-act structure. And then one thing I love, and when we had Professor Damodaran from NYU on this, he's done a lot of work on this too, like the narrative life cycle of businesses and being able to understand how a business ages. And he's done the great work on that. What Ben talks about is how a story ages and how a story progresses over time. And I think this is one of those really useful cases. If you can take what Ben's saying, and you can take what Professor Damodaran is saying, you can start to see the world through an interesting lens. Because then you start to see how different characters, how different actors in the world act at different parts in their own narrative arc, life cycle, or story. How do you think about the multiple layers of this? Because I think that's the meta layer that this blows my mind on.
Yeah, and well, I think also when you think about the layers and you think back to investing, or what we're seeing as investors on a day-to-day basis, I mean, this exact same thing, these exact same acts is what plays out. Think about like inflation back in the day, back in the day, what was it, 2022? I'm pretending like it was 1973, which it was too, I guess, but
olden days of transitory.
Yeah, exactly. I'm talking like an old man here or something. But the idea is you saw inflation coming up, you saw the arc of that, and then you saw everybody in the world telling you about inflation, and then inflation subsided. And, before inflation itself actually subsided, the investability of inflation subsided first, when everybody was telling you, oh, we got to own all these things. All these ETFs are launching about inflation. So it's interesting just to take that, to your point, to take what you see in that Law and Order and carry it to investing, and you see the same exact thing, which I know is a lot of the work Ben is doing these days.
Yeah. This idea of that you can track a narrative through space-time, and you can look at who are the people telling the story, who are the people telling it, and why are they telling it? Where is the story showing up? And then how does that evolve? Because once everybody knows that everybody knows it, to his point, that's when it's time to fade it. That's the time to get away from the narrative, or like step away from your exposure to it. But if you can actually watch this unfold in real time, it can be tremendously useful, not just for your portfolio. To me, this is one of the ways I stay sane with a lot of the political drama and other stuff going on. Because whatever thing that you might be furious about or laughing at the SNL opening monologue about on any given day or weekend or whatever, it's like, okay, that's where the story is hit now for these people saying it, and it's going to be different tomorrow.
Yeah, why I'm excited about this is in a lot of ways, as more work is done around it, this is really an uncorrelated investing factor. Like if you think about someone like me that's using all these factors, a lot of them, not momentum, but a lot of them are tied to the fundamentals of a business in some way. And so this idea, if the fundamentals of a business matter a little less, like thinking about what other uncorrelated factors could I have that I use that might help there, it's just interesting to me. Now, this is not as easily used as some of the other factors because, think about the random $500 million market cap company. There's just not enough narrative information to do anything with it. But like I know Ben's used it around sectors. Like that's a great example. Like it can be used to think about investing in sectors and rotating among sectors. So it really interests me a lot in terms of the future work that's been being done and the work that's being done now around this as an investing factor that people can actually use.
Yeah, I think as an investing factor, understanding how narratives come in and out of your exposures, in and out of your risks, in and out of just, is everybody all of a sudden excited about the thing that I was excited about 6 months ago? Or did I miss the thing that nobody was excited about and everybody's excited? Should I get excited too? If you understand it through this narrative framework, you can spare yourself a lot of headache if you start to just think about the world this way and have some tools to do it, which that's the exciting stuff Ben's working on with his partners.
So we joked about me being kicked off the podcast because Bogomil can talk about the meaning of life with you. So what I'm going to do is start throwing some meaning of life stuff in here so I can really, hopefully you'll be happier with me here in terms of allowing you to talk about this stuff. So here's Ben talking about the mini-max regret framework.
In markets, we are constantly using an highfalutin word, $10 word alert here, right? We're constantly using an expected utility framework to make our investment decisions. So what are our units of risk? What sort of, what's the risk reward? What's the asymmetry here? What are the potential paths that this investment could take, et cetera, et cetera. The big heading for this is called expected utility, right? You're trying to calculate the odds, the outcomes. That's what we do. That's what all of us who are involved in markets do for a living. We wrestle with an expected utility framework for making decisions under risk. What I'm saying is that life is not a decision tree under risk, it's decisions under uncertainty. We don't know all the paths our life's going to take. We don't know the odds. That's the difference. It's the unknown unknowns, right? To use Donald Rumsfeld's famous term, right? It's not the known unknowns, it's the unknown unknowns. Life is decision-making under uncertainty, not decision-making under risk, which is hard to grapple with because in our workaday lives, all of us are doing decisions under risk, expected utility. I believe strongly that the right way to make decisions in a framework of uncertainty is what's called mini-max regret. You're minimizing your maximum regret. It goes back to what we were talking about a life well lived. My maximum regret is looking back and not having that, not just relationship with my children, but the satisfaction of betting on them, doing everything I can to have them launch and lead a life worth living of their own. That to me, when I think about these kind of other two pillars of my investment portfolio, we'll leave the business aside for a while because that's That's my effort to write on my own terms, right? To be who I am on my own terms, not working for someone to do it. But my investment in my home, my investments in my children's education, those are my decisions under uncertainty, where I want to minimize my maximum regret, not because I'm trying to maximize some utility function by, calculating what it's worth in dollar terms to me.
So I won't even attempt to explain this, Matt. I'm just going to throw it over to you because I think you probably have a lot of thoughts on this.
I have a lot of thoughts on this, but in the best of ways. First off, did you follow the whole like known knowns and known unknowns thing? You're the quant guy, so I actually want to kick this part of it to you first. The risk and uncertainty question.
Yeah, I was actually, I think it would be good if you explained it, because this idea of investing under uncertainty or doing anything under uncertainty versus doing something under risk, it's a very interesting thing. And like, I think you could probably explain it better than I can.
Risk is your known unknowns. So risk is like, I have a probability tree and I can come up with the expected values. I have all these poker hands in front of me. I know the expected value of each. I can make an assessment of what's it's worth, if I should make the bet or not. Uncertainty is, I don't have that tree. Like
That's the Donald Rumsfeld thing.
That's the unknown unknowns, where I'm like, I don't really know what's going to happen. And it's other stuff too. It's raising your kids. It's like how you treat your spouse. It's all this kind of stuff where you go, the best thing I can do is just directional orientation and try to keep on the right side of things here. And that's really tricky, because that's the difference of like us as markets and investment people, and like financial planning scenario analysis is all sorts of like known unknowns. We're taking scenarios, we're putting variables and factors and other stuff around them, and we're Monte Carloing them out into the future. And we're like, great, here's the probability assessment, 90% pass rate or 100% pass rate, or only 60%. We should try to button some of this up, but here's where we attack the problem. That's not how most of life goes. Most of life operates under this condition of mini-max regret. And that's how we deal with uncertainty. I'm pausing for a second. Did I explain that well? Do you have anything?
You actually did explain it very well. And that was actually the mini-max regret thing is something I've used. So I remember back to this interview, and I've used since we did this interview a couple of years ago or something, but this idea of minimizing my maximum regret, it works in a lot of different places, and it works in your life, probably maybe more than it works in investing, of thinking about like, what would be my maximum regret here? So what actions can I take to avoid or to reduce the probability of that scenario? I think it's a really good way to live life, probably.
Can I introduce you to a very complicated financial planning topic? That's
Let's
very
do it.
deep. Yeah. Okay. Let me introduce you. I'm going to introduce you to the comment. This is a Minnie Mouse regret. You ready for this?
Okay,
Disney
yeah.
guy. We Disney.
You just come up with this in the spot. And
I came up with this and thinking about this episode after I listened to this clip, because I was like, there are so many friggin' $10 words in this explanation that it hurts me. Minnie Mouse regret. You ready for this?
I'm ready. Let's do it.
Were you a Disney kid? I didn't have Disney as a kid growing up. This is like a blind spot, aside from a couple trips to Disney World with my family.
I did definitely have some Disney. I mean, I'm not like an expert in it, but I did. Yeah, definitely.
Mortimer Mouse. Do you know who Mortimer was? This character in the cartoon?
I do know him, but if you ask me the details about him, I will not be providing those.
All right, I am a 40-something interloper into the world of Mortimer, but I have seen Mortimer. So Mortimer is basically evil Mickey. He's kind of like Waluigi, I guess, but like for Mickey Mouse Land. And like the whole thing with like Mortimer is supposedly like the former lover, perhaps, of Minnie. Like pre-Mickey, they had this relationship.
I didn't know the depth of Mickey Mouse here of the storyline, Matt.
I know. So apparently, like Minnie and Mortimer had a thing, and then there's all this stuff where like Mortimer will show up, and Minnie and Mickey will be hanging out, and they're all happy. But now Minnie's all like, "Oh my God, Mortimer!" And she's going over, and she's thinking like, maybe Mortimer's where it's at. Maybe this is what's going on. And then Mickey always has to figure out a way to win back. The reality of these scenarios is this is not a risk-based decision. There is not like a let's look at the probabilities, let's map this future out, and let's nail this thing down. The end of the day, the only truth that we know is like Mickey good, Mortimer bad. Minnie has to make the decision or figure out through the actions, and it's always through the actions of Mortimer. Mortimer does something shady or evil or ugly or bad, and that's when she goes like, oh, Mickey's the good one. Minnie Mouse regret and Minnie Max regret is basically figuring out like what's good and evil. Again, directional orientation. Not figuring out the exact odds and what the expected value of the hand in front of you is, but the directional orientation towards good in your life and your purpose. That's how Minnie and Mickey stay together. And I think I kind of like this metaphor.
I mean, I doubt Ben will listen to this, but if he does, I doubt he'll be around at this point. But if he is around at this point, I think he's going to love his work being Mortimer Mouse being used as the example of his work. I think he's going to think it's phenomenal.
I'll say this in the 5 minutes or less of research I did on making this point, I was amazed at the evolution of like the way that character's been drawn through history. And I really, again, I saw him and I'm like, oh, I recognize him now, but I had no idea that there's way more backstory. Disney kids, feel free, weigh this one in the comments. I'm sure, like, I don't know, like, did this ever infect the Mickey Mouse Clubhouse? I have so many more questions now if somebody wants to answer them.
Well, I always go back and watch his stuff from when I was a kid, and I'm like, well, actually, there was a lot more depth to that than I thought. So I guess now I'm going to have to go back and watch Mickey Mouse through Matt's framework and be like, oh, yeah, now I understand this better.
If you want to understand probability theory, yeah, dive into Mickey Mouse and try to explain the size of Mortimer's shoes. Very strange. It's a big mouse.
Let's not get into 10 minutes on that because people have probably had enough of us already. Well, anyway, that's probably a good thing to wrap up on. Thank you, everybody, for joining us, and we'll see you next time.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Jack Forehand is a principal at Validia Capital Management. Matt Ziegler is managing director at Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital or Sunpoint Investments.